So with a tactical allocation, you are wanting to move into undervalued assets and trim things that look like they're a little bit overheated. It sounds like a great philosophy, but your calls have to be right, and this sort of gets to what you were saying in the first question. But personally, when you're a practitioner of this approach in the portfolios that you manage, how do you manage the risk of your calls being wrong or your timing being a little bit wrong? How do you think about risk in a tactical approach?
I think about risk in a tactical approach by trying not to load so much into any one asset class that if that asset class hits a severe air pocket, that I won't have the staying power to ride it out, that I won't have the staying power perhaps even to top up during downdrafts. Warren Buffett is fond of saying that investors should be terrified when others are greedy and greedy when others are terrified. Well, back up the clock a year ago, folks were terrified. There was a lot of stuff that was cheap. There was a lot of stuff priced at the richest yields, in some cases, in history, and in other cases, richer yields than we've seen for almost 30 years. High yields reflect investor fear and investor demand for immediate reward. It doesn't mean you're going to get in right at the right time. People who bought, let's say, in October or November of 2008 had to wait for a few more harrowing months before things turned, which brings up the second issue that you need to address with tactical asset allocation, and that's that you aren't trying to pick tops and bottoms. You're trying to get in when markets are cheap and out when markets are expensive, which requires a certain measure of patience. The best tactical asset allocation managers tend to be early, which means that they tend to be temporarily wrong, which means that their investors need to be a little patient.
A question about applying a tactical asset allocation, perhaps in a different life phase. So maybe I'm younger and I do feel like I have the discipline to use a tactical allocation approach. My risk tolerance might be a little bit higher than perhaps if I'm a bit older or if I think that I might need to draw down on my portfolio. If I'm employing a tactical allocation approach, are there ways that I can ratchet up and ratchet down risk depending on my time horizon?
Absolutely. Your appetite for risk should diminish with age and with the amount of time you have left to replenish your asset base if things go wrong. I mean, basically, if you experience a decade like the last one, and you're 25 years old, so what? In fact, you wind up with some markets that are more attractively priced than they were 10 years ago, so your long-term investment success can actually be helped by bear markets.
Sure.
But if you're getting older, losing half your money suddenly becomes very daunting because it means losing half your lifestyle in retirement or losing half of your years of retirement, forcing you to work longer. So the appetite for risk should diminish with age, but regardless of your appetite for risk, there are opportunities to do well with a tactical approach if you have the courage to buy what's out of favor and what looks scary, and the courage to sell what everyone thinks or seems to know is a wonderful asset because it's gone up so much. Those are tough things to do. They go against human nature. If you have the courage to do that, you can add value with tactical asset allocation at any age.
At Morningstar, we feel it is important to schedule regular checkups of your investments. This is the reason we're pleased to announce Portfolio Monitor, a new and easier way to keep track of your investments. With a few clicks of the mouse, receive a monthly report that provides a comprehensive and customized summary of your portfolio, sent automatically to your inbox. Portfolio Monitor provides a concise digest of all the best features of premium membership. Become a premium member with our 14-day free trial to start receiving Portfolio Monitor today.